The fact that silver is broken out now is going to be very hard to put that back in the triangle. BRICS wants the Chinese want them to run the silver market, and the Chinese will run the gold. So that's what I'm hearing. Maybe that's why JP Morgan is sending some of their bullion traders to Singapore, because they want to be in the heart of the action. So that's bullish silver, also bullish gold. We could be by January at 5,200. To buy very positively on path to become one of the world's principal physical silver centers by 2030, driven by DMCC's infrastructure push, new trading tokenization platform. Yeah, I agree. Silver is the place to be, even though I'm not selling my gold. There's very little talk about silver, which I think is encouraging. We finally broke through this 45-year teacup. Someone asked about the silver to gold ratio, not the gold silver ratio, and it looks very bullish. I'm sure you followed the silver market on Friday, and I'm going to bring up this chart. So we finally broke through this 45-year teacup, and it was like emphatic. So it looks really bullish, and a lot of people are very bullish, but and that's understandable. But you look at the mainstream financial press and other press, there's very little talk about silver, which I think is encouraging. What's your view?
I think the high point was $56.72.
Let's
I'm not
have a
sure that
look on
was
the spot.
not sure if that was on the spot of the future, but that's
This
the figure I
says
saw.
here 56.54. This is the spot.
Okay, that was the high point on the spot.
Yeah, and we
Yeah,
closed, I think, at 50. It's here the close 56.40 basically. So
yeah, okay. So, what the previous peak I think was a few days ago or whatever it was $54, and then on Friday we just had this sudden when we actually saw a proper price, because unfortunately I was looking at multiple prices which didn't make sense at times. But when I did see it, it seemed to just gap up, like there's a gap,
yeah,
like an empty space.
yeah. The high in October was 54.48. So we
Okay, so
we
that
went
was the peak we went
comfortably up.
through.
That sudden gap move in silver is a reminder that markets reveal their truth only when manipulation pressure disappears. What stands out is how a 45-year breakout barely registers in mainstream coverage, even though silver jumped past 56.72 cents and closed near $56.40, levels unseen in decades. As analysts like Mario Innecco and Clive Thompson often note, structural shortages don't announce themselves in headlines. They erupt in price action. Investors should focus less on hype and more on liquidity signals like this kind of clean gap through resistance. And what comes next sets the tone for the entire metals complex.
Yeah, I mean, we had that high, I think it was October 16th, and then we had that big correction, which looking at a monthly chart, you can't even see it. But let's do it as a daily chart, then you can see.
Yeah.
So that was the old high here. Let's see, 54.48, yeah. And then we had the big correction. We went back up and down, and now, I mean, this looks, a lot of people were thinking that this was going to be a double top, and that we're going to break here and then go back down to 37. But I think that's been negated now.
Yeah, I mean, I have to say I was surprised, but when you get surprised, it's usually an extremely bullish move, and you can see the strength of that move up. It's a very strong,
Yeah.
long green bar. And as I said, I think this was in some way reflecting the fact that suddenly people couldn't trade the futures. Therefore, there was nobody out there to suppress the price on the futures exchange, pulling down the spot price, and silver found its true price.
Yeah, and even the few days before it, it was doing quite well. So anyway, let's oh, I got a few other charts. That's the Dow gold ratio. That's another important thing. Someone asked about the reset, financial reset. This is part of the reset here, the Dow gold ratio. And
This no double top moment matters because failed bearish patterns often fuel the strongest upside runs. With the October high at 54.48 taken out decisively, the long green bar signals genuine buying, not futures-driven noise. Even analysts Mario Innecco warn that when futures liquidity dries up, spot prices reveal their unfiltered supply-demand reality. The mention of the Dow-Gold ratio hints at a deeper structural shift investors rarely price in. Next, they dive into why that ratio may be the real reset signal.
A lot of people think that we're going to go back to 1 to 1. So the price of gold, you will need 1 ounce of gold to buy 1 Dow. And I think that's possible. In 1980, it went down to 1 to 1. In 1932, it went down to 2 to 1. And we've broken really key support here in the Dow Gold ratio. It went down to like 6 in 2011, and we've had like this top, and now I think we're going a lot lower. It's a bit sticky, this ratio, but I think eventually in the next 2 years we could see it at 1 to 1, and that is a reset. Don't you agree as well? In terms of financial reset, not a digital currency reset.
Well, it's certainly silver and gold returning to their true value to reflect the generalized rise in other assets. I
Yeah.
mean, we've seen, and I've got a chart. Maybe I can show it to you. If I can I share a screen with you, Mario?
Yeah,
It's of the
let me allow you to share. Uh, I'm gonna look at some super chats while you get that chart. Uh, NIT
okay.
the diver, thank you for your super chat. This is not just government overreach. This is the 666 beast system rising. Yeah, you're talking about Europe, I assume.
Quiet collapse of the Dow-Gold ratio is the kind of shift Wall Street avoids discussing because it exposes how inflated financial assets have become. Historically, this ratio hitting 1 to 1, last seen in 1980, signaled extreme equity overvaluation or a massive repricing toward hard assets. With support already broken and the ratio sliding towards 6, the trajectory lines up with Mario Innecco and Clive Thompson's warning about weakening breadth across the Dow since 2021. If gold strengthens while earnings stagnate, this convergence becomes unavoidable. And the next chart makes that imbalance impossible to ignore.
Uh, and he's done it again. Thank you. You've done the super chat twice. Yeah, thank you, NIT.
Can you see the chart, Mario?
Yeah, yeah.
So this is showing the U.S. government debt against the gold price since 1971. So we've got the gold price on the right-hand scale in the left-hand scale in dollars on a logarithmic scale. That's the red line, and we've got the U.S. government debt, which is the area chart with on a logarithmic scale on the right-hand side. So back in 1971, the U.S. government debt was about $38 billion, and now it's $37 trillion, about 100 times as much. And if you look at the, I'll go back. If you look at the blue line, the straight blue line, that's sort of a line of going through all the middle points roughly. That just shows the trend we've had, almost a straight line up in government debt on a log scale. Obviously, it'd be curving upwards if it was not a log scale. And we can see where the government debt goes to. It should be on this line by 2050, 320 trillion.
This chart quietly exposes the core problem. Gold's long-term trend mirrors the exponential rise in U.S. debt, and that's not a coincidence. Since 1971, debt ballooned from $38 billion to $37 trillion, a nearly 1,000-fold increase, while gold followed the same logarithmic slope. Mario Innecco argues this linkage reflects declining confidence in sovereign balance sheets, not just commodity cycles. If debt reaches $320 trillion by 2050, as the trend line suggests, hard asset repricing becomes a structural inevitability. And the implication for investors becomes sharper in the next segment.
Yeah, Clive, just a
Dollars.
little correction, and sorry to interrupt. The debt in 1971 was 398 billion, not 39 billion.
Okay.
And
Oops. So I got that figure. I got that figure from ChatGPT actually. So maybe it's wrong.
Or maybe you missed a zero. I don't know.
Yeah. So anyway, but just projecting forward, if I put the put the gold price on the same line, I see that by 2027 we might be, and this is obviously speculative here, if gold follows the rise in government debt, we might be at 5,900.
Yeah, I mean,
Sorry,
that's
yeah, Mary, you're right. It does show the correct figure on the chart. I was looking at the left-hand scale, which
oh,
shows
that's okay.
yeah, $35 for gold. The right-hand scale is over here is does show 380
Yeah,
trillion, 380 billion, and now we're at 37 trillion or
I'm more
30.
I'm more bullish than that 5,900.
Well,
I'll
me
tell
too,
you
but
why, Clive, because I think the way I don't think gold follows the national debt. It follows more the debt that America owes to foreigners. That's what Jim Sinclair calculated in the early 70s. And he came up with almost a $900 gold, and we went to almost 900 in 1980. And that means that the US debt covers debt owed by foreigners. And right now it's 9 trillion.
When debt owed to foreign holders becomes the anchor metric, gold valuations shift into a completely different realm. What's troubling here is how foreign held US debt, now around $9 trillion, introduces a valuation framework far more volatile than simple national debt growth. Jim Sinclair used this logic in the 1970s to project $900 gold, and history validated him when gold nearly hit that level in 1980. If that same foreign obligation model holds, then $5,900 may actually be the conservative case rather than the aggressive one. The deeper issue is how rising external liabilities pressure long-term confidence in U.S. fiscal credibility. And the next segment pushes this argument even further into today's debt to GDP crisis.
So I think it could be a bigger number, but
well, I'm also more bullish than the $5,900 target I see there,
yeah,
because I think this curve, the of the US government debt, is going to slope upwards. And the main reason for that was back in 1971, the debt to GDP ratio was 25%. Now it's as good as 100%. And the interest burden is increasing rapidly. So for that reason, I am expecting the debt to start to spiral out of control at a faster rate than the straight line we saw. And therefore, I think that the gold price will go at a faster rate too. So I think I'm in agreement with you. I'm more optimistic than what the line I showed shows.
mm,
But it depends what your on what basis you're trying to project a future price. Are you trying to be cautious or are you trying to be optimistic?
yeah, yeah.
And if I
I
was
know.
cautious, I'd say it's only going to be $5,000 cautious basis.
Yeah, cautiously. Anyway, let's see. I was trying to get another gold chart, but I can't bring it up. Let's have a look. Doesn't seem to be. Oh, we're back. Uh, I'll bring up this monthly chart.
When a country's debt to GDP quadruples, asset pricing models stop being forecasts and start becoming warnings. The shift from 25% debt to GDP in 1971 to nearly 100% today is not a small structural change. It's a fundamental re-rating of national solvency risk. As interest costs accelerate, deficits compound faster than growth, creating a feedback loop that gold historically responds to with exponential rather than linear moves. Analysts who anchor to straight line projections ignore the way compounding debt crises behave in real markets. Even a cautious $5,000 gold target assumes stability that the fiscal math no longer supports. What follows next is a chart that hints at an even steeper trajectory.
Um, Let me share it with you guys. A gold. Here we are. There's the breakout of this teacup and handle, right? But this other line here, I've been following it for the last few years. This one, we broke that last year, and there was a bit of a correction there after the election, and then we've gone back up. I just think this is so strong that I can't see it stopping now. It looks like the chart of the German mark or during the hyperinflation. We had a very similar. So I think it's going to get out of control. I personally think we're going to see 6,000 next year, which is a year before that. So anyway,
When long-term technical patterns start mimicking historical hyperinflation charts, investors should question whether price action reflects fundamentals or system strain. This breakout above multiple multi-year trend lines signals more than bullish sentiment. It reflects underlying monetary distortion. Comparing this move to the German mark's hyperinflation trajectory isn't casual. Parabolic structures often emerge when real yields collapse and fiscal anchors weaken. Elections, liquidity boosts, and currency debasement cycles all compound the momentum. If gold is already tracking that slope, a jump towards $6,000 isn't speculation, it's a stress signal. And the next part shifts focus to silver's relative strength inside that same pattern.
someone asked about the silver to gold ratio, not the gold silver ratio. It's the other way around. So this is a percentage of the gold silver as a percentage of the gold price, and it looks very bullish. We closed at 1.33%, and I think Michael Oliver from Momentum Structural Analysis, he had his key level was 133. So I think silver is the place to be, even though I'm not selling my gold. But I think in terms of the miners, Clive, I'm leaning more towards having silver mining companies because I think even though the gold miners, I think are going to do well as well. They're going to outperform. Yeah.
I did a bit of research for a friend a week ago now on some gold and silver miners, and he named a few stocks. I won't name them specifically because I partly can't remember them now. But the ones I looked at, the silver miners had far more upside potential than the gold miners. I mean, the gold miners were, upside potential 100% easily or more. But the silver miners that I looked at were multiples of that.
Yeah, and this is the gold silver ratio, the one most people look at, and that's breaking down as well.
When silver crosses a structural momentum threshold like 1.33%, professionals notice long before the headlines catch up. Michael Oliver's 1.33% level isn't arbitrary. It marks the point where silver historically begins outperforming gold on a multi-quarter basis. That explains why silver miners show several-fold upside compared to the typical 100% runway in gold miners. The breakdown in the gold-silver ratio adds confirmation. Capital rotation toward higher beta monetary metals is underway. For portfolio builders, this shift can change risk-reward dynamics dramatically, and what comes next builds directly on this accelerating divergence between gold and silver.
So that's bullish silver, also bullish gold. And there's another chart here because some people might be thinking, gold hasn't broken its old high of 43.80. But if you look at this triangle, Clive, let's put it on a daily. I was looking at this triangle about a week ago,
Yep.
and I
It's broken
said,
out. It's broken out.
it doesn't really always work, and it might still be, it might still come back, but I think the fact that silver's broken out now is going to be very hard to put that back in in the triangle or back in the box, so to speak.
Yeah,
So
if
this looks very bullish
you could make the flagpole going all the way down to
here.
3,300. Well, actually,
Yeah,
if you put the flagpole under the upper diagonal line and go straight down to 3,300,
yeah.
you've got a perfect flag pattern there.
Yeah, that's so that's about 3,000. It's about $1,000. So if you add $1,000 to 4,200 or 4,170, well, that's like 5,200. That's very, that's the objective. And this took what, end of August to end of October, mid of October. So We could be by January, we could be at 5,200. So that's pretty
Yeah.
exciting.
Everyone watches the headline gold price, but the real tell here is silver breaking out while the gold triangle tightens. That divergence often precedes major regime shifts, just like in 2010 when silver front-ran gold by nearly 6 months. The flagpole projection to $5,200 isn't magic. It's pure measured move math, lining up with the 2024 liquidity expansion. But investors should ask whether this pace reflects true demand or speculative pressure building beneath the surface. And what Mario Innecco says next sharpens the implications for anyone timing this breakout.
But it's going to get a lot choppier, don't you think, Clive? People need to have a strong stomach.
Yeah, I think for those who haven't got enough gold or silver, and obviously maybe there's a little bit of panic because they don't feel they've got enough yet, I think the way to play it is to buy a little all the time. So, and it doesn't matter whether you pay more or less than you previously paid, but if you ease it in, you know that the long-term direction is going to be higher, because almost certainly because we've got higher aggregates of everything from money supply to government debt to stock market. It doesn't really matter what you look at. Everything is, they're printing money like there's no tomorrow, effectively. So everything's going to be higher, and gold probably will go with it. So
Yeah.
if you gradually buy, of course you'll have some bad days when you buy, and you have some good days. Sometimes you pay too much, and sometimes you pay too little. But don't throw it all in on day one, because if tomorrow, and I don't think this will happen, but if we wake up on Tuesday and it's gone down $50, it's really going to hurt that you put all your money in on that highest price.
Yeah.
You'll feel much more comfortable easing it in.
The real message hiding here is that volatility isn't the enemy. Impatience is. Dollar cost averaging has survived every major cycle, from the 1970s inflation spike to the 2008 liquidity crisis, because it shifts focus from timing to accumulation. As money supply M2 remains more than 35% above pre-COVID levels, long-term upward pressure on hard assets is structural, not emotional. Investors should treat dips as noise, not signals, especially while fiscal deficits keep widening quarter after quarter. Next, Clive Thompson digs into how structured buying shields you from psychological traps.
Maybe one third now, one third in a couple of
Yeah.
weeks, and one third in a month and a half.
Yeah, dollar cost averaging. Yeah, I mean that's what I try to do. Or it's not every time that I have the spare fiat to buy gold or silver. To buy very possibly on path to become one of the world's principal physical silver centers by 2030, driven by DMCC's infrastructure push, new trading tokenization platforms. Yeah, I agree. That's what I'm hearing as well. Uh, and I think it could be before 2030, personally. Anyway.
I've never been to the gold market in Dubai. Been to Dubai, but not the gold market. But it wouldn't surprise me if they don't develop a silver market too.
Yeah, and that's what I'm hearing, Clive, that they're gonna be like BRICS wants the Chinese want them to run the silver market, and the Chinese will run the gold. So that's what I'm hearing. And unfortunately, yeah, and maybe that's why, we don't know yet. Maybe that's why JP Morgan is sending some of their bullion traders to Singapore, because they want to be in the heart of the action. Uh, anyway, we've got a minute to go, Clive.
When talk shifts from price targets to global market control, that's when investors should pay closest attention. If Dubai becomes a major physical silver hub by 2030 or sooner, it reshapes supply routes and weakens Western pricing dominance, similar to how Shanghai cracked gold price discovery in the mid-2010s. The mention of JP Morgan shifting bullion staff to Singapore signals institutional repositioning, not coincidence. These geopolitical moves often impact metals far more than daily charts ever show. And the next part reveals why structure matters even more than geography.
Any final words for the viewers? Seeing that we could actually be, because I think it's just as important to be calm and not get excited when the market corrects a lot, like it did in mid-October, but also in what it looks right like now, it looks like we could get a massive move higher in the next month or two. So yeah, how do you cope with that, Clive?
Well, first of all, I hope it doesn't happen because I would rather that the gold and silver price rise rather more slowly than I fear it will. The trouble with massive rises, it brings out armies of sellers when people see a price which is vastly different from, say, a week ago or a month ago, they tend to think they've got to do something. Whereas if it creeps up or down very gradually, they don't feel the urge to do something. So obviously, a sharp rise in the gold or silver price would bring out a number of sellers, which could therefore cause a sharp fall afterwards. Whereas a more gradual move, people just sort of, no big deal. It's not moving much. I don't have to take action. But sudden move, people think this called this reversion to mean. Everybody in their brain is looking for a pattern. So
Yeah.
when something is looking different from where it was, they assume that yesterday's price or last week's price was the correct one, and that's how they trade.
A surge looks exciting, but the psychology behind it can be far more dangerous than the price itself. Sharp vertical moves historically trigger liquidity shocks. Just look at gold's 2011 spike, where a 15% rise in 2 weeks led to a brutal reversal as profit-taking overwhelmed buyers. As Clive notes, markets move smoother when fear and greed aren't amplified by rapid swings, and that stability protects long-term accumulation strategies. Investors should focus on trend durability, not dramatics.